Hey everybody, this is Dan Hussey, bringing you a special report on the S&P 500. I've actually got a monthly chart because we're going to be looking at some technical indicators that we don't normally look at, specifically the 50-month and the 200-month, and then the 50-day and the 200-day moving averages. And I want to show you where we are because this is actually a kind of an important point, in my opinion, in the market and for this technical indicator, because the potential cross that could occur hasn't happened since the 1929 crash or after the 29 crash. Of course, it crossed back over in 1946, but since then, the 50-day has always remained above, or 50-month has always remained above the 200-month moving average in the S&P 500. So let's take a look, shall we? Let's take a look and let's go back to the last time they crossed over. Unfortunately, my data feed stops and doesn't show us the original crossover, but we can imagine that it occurred sometime right after the Great Depression, the original negative cross. It would have had to have, if we can extrapolate out this 200-day, we could assume that it occurred actually sometime right after 29, right into 3031. That's just drawing a line straight over. So with that being said, in 1946, the 50-month crossed back over the 200-month, and ever since 1946, they have never put a bearish cross in. The closest they came was after in the 1970 70 to 76 recession, the early 70s, when we were in a recessionary, very similar price action, very similar price structure. We pulled into a full halfway back, 50% of all time at that time too. The lows in 1974 were a 50% pullback drawn from zero to the all-time highs of the S&P 500 at that time. Okay, so this is our first Great Recession. If we had expanding flat price action, so that means we, off of our highs, we came into the recession, we came down to a low, we rallied up to a new high, and then rallied down to a new low, and then rallied off that low. That's called an expanding flat, an Elliott wave. And in 1978, the 50-day and the 200-day came within 2 points of each other. 2 points back then was the equivalent of 10 handles today, or came within a point of each other. So it's the equivalent of coming within 10 points today. We then entered the greatest 30-year bull market, 40-year bull market the market has ever seen. We put in another expanding flat in the 2008 recession that traded to a low, to a new high, and back down to a new low, held a 50% retracement of all time. And now the 200-day, and we can get really close to it. You can see how the 50-day and the 200-day, you can see how the 50-day has started to turn up. And this is the type of turn or bounce off of we want to see to maintain this bull market. I'm not saying they could cross and couldn't continue higher, but this is the, not seeing them fail to cross, which you can barely probably see it, but you can see how the slope has started to turn up on this 50-day, or 50-month rather, moving average. And we're going to go look at the daily ones so you can have a good idea of what I'm talking about and why I have a feeling if August can close green, these are not going to close. These are not going to cross over. And they are, they're within just about 10 points of each other right now. But the idea is that unless they cross, we're going to have very similar as we did in 1976, the fail to cross, and then potentially, I've been talking about how we could have already seen the generational low. Well, that's what we did. We saw the generational low. Actually, 3 years prior to this happening, and sure enough, this is 2012, and we had our last low 3 years ago. So there's absolutely no coincidence in this type of market, or in the market, in these type of really long-term indicators that are probably the only time we ever look at moving averages. So let's move down to the daily. Specifically, I want to show you what the daily moving average is looking like, or the 200-day and the 50-day. Now, this is actually the first time, and this occurred about 2 weeks ago in July, when the 50-day finally pulled away from the 200-day and failed actually to cross over the 200-day in a bearish cross. This is the first time since 2009 that that's happened. Okay, So every other time we've had a big major pullback in the stock market, um, and every year really since 2009, we've had a bearish crossover. 2010, 2011, and in 2012 we actually have so far failed to have a bearish crossover in the 50-day and 200-day moving averages. So just supporting the idea that the stock markets is actually gaining steam to the upside and not slowing down, um, which sounds interesting. But we haven't had this happen since 2006 or 5 rather. We had a failed cross. We had a failed cross. So you can see this is what I'm talking about. This is the look. This failed crossover leads to a continued rally. Um, so there is still short term, there is still upside, and this is bullish, having a failed crossover. Why don't we go back and look at 19, and I actually haven't even thought to look at this yet, but the daily price action here from our last low, and you can barely see the price action because of the way the data feed is, but you can see, oh, actually this isn't great because it goes into a logarithmic scale, which skews things a bit. But we haven't had bounces in the 50-day and the 200-day since like the 90s. You can see in the 90s how we would bounce off. They would always fail to cross over almost the entire time in the 90s. The 50-day and the 200-day almost never crossed with the exception of 1994. They just always bounced off each other, and then of course as we started getting closer to a top, you started getting that the moving averages, and even to the downside you can see how their failure to cross, what it leads to. So just something else to note. I wanted to point this out because, hey, it's interesting research I've seen from I've seen people talking about these in this market, and I figured, hey, why not share this? So hope you guys enjoyed that, and why we are at least short term and long term still bullish on the S&P. Until we're proven otherwise. So until they do cross below, this is very much and we've looked at this before, how this is the 1970s recession in terms of price action. It's almost a perfect analog so far. Just with, you have to take into account, inflation and everything else into price, but we're coming out of this period at the same rate, at the same time. This is 3 years almost exactly, from everything is occurring at the same time. I don't think you should just ignore that. So have a great one, and we'll be back with you as price action develops.